Here is the Mortgage Minute with Sly Marinca and Cross Country Mortgage on Unlocking Lake County with Dick Barr.
Thank you. Good news this week.
I love good news.
Well, welcome to the teeter-totter of mortgage interest rates, where one week it's the end of the world and rates are going to 10%. The next week it's like, let's hold off for a minute. Last week, if you remember, the rates were near 7.4% was the national average. This week they're down to 7.07%. So that's a pretty big drop in 1 week.
Nice.
The 10-year Treasury yield last week was around 4.6%. This week it's down to 4.29%. So again, a pretty big swing in 1 week. So what the heck happened? I don't know if you remember, but last week when we met on Wednesday, there was a big inflation report, a big inflation reading that was coming out on Friday, May 31st. And basically that report came in line with expectations. It did not... the inflation reading did not come in higher than what was expected for April. So the
Sorry.
Still going. It was that good.
It's worthy. Oh, sorry. Keep going.
Yep. So, So basically, the number came in line. It was 0.3% for the month of April, and that's kind of what was expected. So, when the market anticipates it, that's when things kind of that's a good sign. It's when inflation comes in way hotter than what was expected. That's when rates go up because the markets think the Fed is going to keep on raising the rates. And it just goes to show you. I mean, the markets are fully ready for lower rates. I mean, they're expecting this to happen. It's built in. And that's why even though it wasn't a big miss and it wasn't like inflation came in way lower, it just came in at what was expected. Rates did come down significantly. And then
That's great.
Add fuel to that fire, just this week, the May ADP jobs report came in lower than expected. So again, that's not a great thing for the economy. And typically when the economy's not doing great, that's when the Fed has to lower rates, right, to kind of boost things up. So the May ADP jobs number came out that 152,000 jobs were created when it was expected for 175,000 jobs to be created. And that was for the May ADP number. And then April was also revised downward as well. So
they went back.
Correct. They go back and they look at it and they realize that there was maybe some jobs counted twice or some error in their accounting methods. It looks like unfortunately employment is starting to jobs aren't as hot as they were. The jobs numbers that are coming out. So not great for the economy, but if you are looking to get a lower rate and kind of waiting for that, it seems like we're starting to move in that direction. I got to find something wood to knock on because, we thought the same thing in December. The Fed pivot we've talked about numerous times where, the Fed basically said they beat inflation. We're good to go going forward. We're going to drop rates 6 times in 2024. Hasn't happened. So at least for right now, it looks like things are moving back the other way. Like I said, in a 1 week period to go from, almost 7.4% on a 30-year fixed mortgage average to down to 7.07%. That's a big drop.
So I do want to say, if you have been sitting on the sidelines and you're a buyer and you're hearing this broadcast and you're hearing on one hand, we're starting to see inventory increase, options increase, bidding wars decrease, interest rates now decreasing. If you're looking to strike while the iron's hot, now's the time.
Absolutely.
Not waiting for another quarter point drop. That's even if it does drop another quarter point, we're not talking about massive dollars.
Right.
Buy while the competition is low. You're going to save probably anywhere from $10,000 to $50,000 in a bidding war. Right.
Absolutely. Yeah. I mean, so those are all great things for home buyers. Maybe not so great or not as great for home sellers, but hey, they've gotten their cake and they've eaten it too for the last 2 years with these price increases. So,
but let's be honest, most home sellers are then also home buyers.
Yeah, absolutely.
So
So kind of a good way to look at it. If you've been kind of waiting for, not wanting to get in that bidding war, not wanting to pay almost 8% for an interest rate, You know,
I don't blame you.
It's me neither. And it seems like things are kind of moving in that direction in my world, at least.
Isn't 7% the long-term
Yeah.
average?
Yeah, it's still the average. If you look at, you know, the historical mortgage rates, right around 7% is still kind of what the average is. So, you know, the 3%, 2% rates that we had in 2021 and, you know,
That was the historical event.
That was it. Yeah,
not the norm.
We may never see that again. In fact, I've been doing this since 2002, and you know, I've talked about it before that, you know, when I first started, the rates came down below 7% the first week I was in the business, and it was like the world was ending because, you know, people were refinancing from 7.9, 8.5, 9% to 6.875, and it was like the best deal ever. And then I remember when it went to 5.875, and again, it was like, holy cow, we'll never see rates this low again. And then now in 2021, when, you know, we're literally doing 2.5% 30-year fixed rates, it's like, okay. But in any case, something to, you know, to kind of think about if you are looking to purchase a home. Doesn't hurt to, you know, give it a shot now when the, you know, when the market's more inventory and rates have crept down a little bit. Then we'll keep updating you weekly on what the rates are doing.
Absolutely.
Yeah. So so that's that. Then real quick, I wanted to also touch on something that I've seen happen several times in the last month, and maybe some home, you know, maybe some people out there don't even realize or understand that this is possible. And it has to do with when you're purchasing a home from a relative. If you know, if it's grandpa's estate or if it's, you know, a family member that is looking to get rid of their home and you're wanting to purchase it, and you don't have the money available for a down payment, or even if you do, you don't want to put your own money into the transaction, there is a way to do what's called a gift of equity.
Ooh, what's that?
It's basically you're purchasing a home from a family member and they're giving you a portion of the equity as your down payment. And you could also have them pay for your closing costs. So in a lot of cases, gift of equity transactions, and I've had 3 in the last month come up where it's like, hey, I want to buy this house, you know, and family members willing to give it to me for a slightly, you know, or a significantly lower price than what they could actually sell it for. And that's fine. You could do it that way, but if you're just paying what they're, you would have to come up with the money out of pocket. But if you buy it so like let's just give an example. So I don't want to confuse anybody. If you're buying a house that's $200,000 from your grandpa, and that's what you agreed on, but the house is worth way more than that, you could actually say, all right, well, this house is worth $250,000. I will buy it from you for $50,000. You only want $200,000. That's what we'd agreed upon. I could take that extra $50,000 and use that as my down payment. So now I'm not having to come up with the down payment. That is my down payment. It makes the terms more favorable because now I have 20% equity, so I could avoid PMI. I could look at doing a conventional loan versus an FHA loan or something like that. So it's something that if you're ever in that situation, reach out to a good local loan officer, a good lender that knows what they're doing, and they may be able to save you quite a bit of money. Obviously, there may be some tax implications, so always talk to your accountant because anytime you're getting a gift, you know, you got to be careful about that. You don't want to get whacked with a big IRS bill next year when, you know, you buy a home, and, you know, you want to be prepared for that if that is the case. Talk to your CPA about that. But if you're ever in a position where you're purchasing a home from a family member and they're giving you a good deal, talk to a lender because there may be a way for you to buy that home with nothing out of pocket, no closing costs, and get a much better deal than if you were just trying to buy it on your own.
No closing costs.
Well, they're rolled into the loan in essence.
I see.
You know, they're giving you a credit for the down payment, and they could give you a credit if the equity's there. You know, if the house is worth $200,000 and grandpa's selling it to you for $200,000, all bets are off.
Sure.
But in my experience, most of the time when we're dealing with this kind of thing, it's like, I want to help you. I want to give you a good deal. And that's basically, you know, you're taking that good deal and you're making it better. You're making even a better deal for yourself so that you don't have to come up with all this extra money. You don't have to come up with a down payment. You're using the equity that's already in the house for your down payment. So coming up quite a bit lately. So something to think about.
So let me ask a question. Just I don't know if this is a different way to get to the same location or if this is not a thing at all. I'm just curious. If, let's say, grandpa adds you to title, now you're on title, could you then at that point refinance out of grandpa's loan into your loan at, let's say, a 75 or 80% LTV?
You can, but typically you would have had to have been on title for at least a year.
Oh, okay.
So it's not something like, if you plan ahead and that's the plan, and talk to a good estate planning attorney, and if grandpa says, hey, I want to leave my grandson my home, that would be the best way to do it, because then the transaction costs, now you're paying closing costs on a refi, not on a purchase.
Right. But
you have to do it, well ahead of time, to be able to treat it that way. So yeah, always seek anytime you're in a situation like that, you want to seek good professional advice to make you to put you in the best position possible.
Because there are always options available that you probably know nothing about and have never even heard of.
Absolutely.
And
So
that just nails what I think the purpose of the show is to don't be afraid to talk to people.
Right.
Especially when it comes to people like in your industry, people in our industry, because we don't charge for answers.
Correct.
We only charge for results, right?
We love giving answers.
We
love it. It's never an inconvenience to ask us. We want to provide that information to people.
And it's like, this is what we do. Like, if I could help somebody, even if I don't get a deal out of it, if I could point them in the right direction and they get what they want, that makes me happy. I'm happy to share the information. So yeah, but getting out there and getting the information, that's the hard part, because sometimes people just, put it off, and there's so many situations where I've told people, hey, this is how I would do it. This is what I would do. And, they call me a year or two later and it's like, we haven't done it yet. It's like, okay, no problem. But
I think a lot of times what happens too is people are under the impression that they need to get all of their ducks in a row first.
Yeah.
And then call a lender once they're ready, right? Or they need to get everything figured out and then they call a realtor to get moving forward.
Right.
And that's fine. I mean, I know that from personal experience, we pick up the pieces wherever you're at and we go from there.
Right.
But more often than not, like you're saying, if you were to call someone at the beginning of your journey and start getting some direction on where you're going, some options available to you that you didn't realize, like you could have saved yourself hours and weeks and months potentially of research that you didn't need to do on your own, that might not even really be the most relevant or up-to-date research in the first place. That's what we're here to do, is to answer questions and help our community.
Oh, there we go. And to echo that even more, from a financing standpoint, getting in early, we talk about it all the time. It's like, don't wait until your lease is 60 days before your lease is up to have your credit checked, because it's like, there's so many things that you can do ahead of time to put yourself in a better situation to possibly qualify for a little bit better program or for a little bit of assistance, rather than just waiting till the last minute and hoping for the best. Get in early. Talk to somebody 6 months before your lease expires, a year before your lease. The earlier you do it, the more time you have to prepare, the more time you have to save, to pay off debt, whatever it is, instead of just hoping for the best when it comes time.